In this chapter, we're going to discuss corporate non-liquidating distributions. Non-liquidating means not going out of business. So these are distributions from the corporation to shareholders that happen in the normal course of business. The most important concept in determining whether such distribution is a dividend or something else is earnings and profits. Section 316A says that a distribution is a dividend to the extent it comes from earnings and profits. And earnings and profits aren't defined in the code, but we do know that they're separated into current and accumulated. So current earnings and profits are computed on the last day of the year without regard to distributions that year. Accumulated earnings and profits are all the previous results of earnings and profits added up. Pretty simple. A distribution will be taxed as a dividend even if historical losses to the corporation have accrued so long as the corporation has current earnings and profits. So if we have earnings and profits sufficient to cover a distribution, the distribution is going to be taxed as a dividend. But if distributions during the year exceed current earnings and profits and accumulated earnings and profits, it's going to be treated as a return of capital to the extent that the shareholder has basis in their shares. And beyond that, it's going to be taxed as a gain. If during the current year distributions exceed current earnings and profits, we're going to allocate current earnings and profits on a pro rata basis regardless of when during the year the distributions occurred. And then distributions exceeding current earnings and profits are going to be deemed to be made in chronological order out of accumulated earnings and profits. That's going to make more sense in a little bit. We're going to do an example. But basically, if I have multiple distributions throughout the year, I'm going to allocate the current year earnings and profits based on the amount of those distributions. So pro rata, based on the amount of those distributions. After I have exceeded my current year earnings and profits, I'm going to allocate the accumulated earnings and profits chronologically. So I'm going to allocate accumulated earnings and profits to a dividend that occurred in February before I allocate it to a dividend that occurred in August. As I said, earnings and profits is not defined in the code. It is answered in the regulations and in case law. It's intended to measure the true economic performance of the corporation, kind of like retained earnings. It's not exactly retained earnings, but it's kind of similar to retained earnings. So we are going to make some adjustments to taxable income to arrive at current earnings and profits. And remember, our goal here is to get to economic performance rather than just taxable income. So we start with taxable income, and we add back certain items excluded from taxable income, but that increase economic performance. Some examples of those might be municipal bond interest. We know that municipal bond interest is not taxable. We don't include it in gross income, but it actually does increase our economic performance. All right, then another example might be life insurance proceeds, federal tax refunds, excludable discharge of debt, and realized but not recognized gains. All of those things are not taxable, but they actually do increase our economic performance during the year. We're also going to add back certain items deductible in determining tax income. Some of these might be the dividends received deduction. We have covered this already, and we know that between corporations, depending on how much the corporate shareholder owns in the corporation, they get to exclude a portion of the dividend from income. But just because it's excluded from income doesn't mean it didn't increase economic performance. So those are added back. Depletion that we get to take on our tax return must be based on cost, not percentage. So if you think way back to when in your individual income tax course, when we calculated depletion of natural resources, there were two methods. There was cost depletion and percentage depletion. Cost depletion was based on the actual depletion base, the cost of this asset. Percentage depletion was just a percentage applied to the income from that operation. So if you have been using percentage depletion, which most companies are because it's more, for earnings and profits purposes, you have to go back and calculate based on cost. And then finally, a net operating loss carry forward is going to be added back because a net operating loss carry forward. It didn't happen this year. It didn't really affect economic performance this year. It just was a carryover from a previous year. Number 3, we subtract certain non-deductible items. So from taxable income, we are going to subtract such things like federal income taxes paid. When I pay my income taxes, I don't also get to take a deduction on my tax return, but that does reduce my economic performance. It takes money out of my pocket. I will subtract losses that were disallowed by Section 267. So Section 267 prevents losses between related parties or postpones them. Well, if I have a loss that I couldn't deduct for tax purposes, that doesn't mean it wasn't actually an economic loss. I can subtract all charitable contributions, not just those that meet my limits. All right, so we know that we have limits on the deductibility of charitable contributions, but that limit is not going to apply when I am calculating earnings and profits. All right, and then the last thing, certain timing adjustments must be made. So this is to override timing rules that allow a corporation to artificially defer income or accelerate deductions. Depreciation is one of those. We know that for tax purposes, we depreciate based on makers, and we also take Section 179 sometimes to allow bonus, and we take bonus depreciation. So regarding depreciation, we must use the alternative depreciation system for earnings and profits purposes, which, if you think back, the alternative depreciation system depreciates on a straight line basis. So it's going to depreciate slower. If we took Section 179, instead of taking all that in the year that we deducted it on our tax return, for earnings and profits purposes, we need to deduct it over 5 years. And then if we had any realized gains that were deferred through an installment sale rules or something else, those things would need to be added back. Okay, so when we have a property distribution, if we are the shareholder receiving that distribution, these are the questions I want to answer. I want to know, what is the amount of the distribution? To what extent is it treated as a dividend? And then what's the basis of the property distributed to the shareholder? And when does its holding period begin? So again, I need to know the amount. How do I measure the distribution I've received? Is it treated as a dividend? And if it isn't, how do I treat it? And then finally, what's the basis in the property I received, and when does the holding period begin? So if the property distribution is cash, that's pretty easy on the shareholder side. The amount of distribution is easy to measure. It's just the amount of money I received. It's going to be treated as a dividend to the extent we have sufficient current earnings and profits or accumulated earnings and profits. And then the basis of the property distribution is just the amount of cash. This one is pretty simple. All right, so here we have Young Corporation, and we want to know what effect the following transactions have on the calculation of Young Corporation's current earnings and profits. Assume the starting point for the calculation is Young's taxable income for the current year. All right, so they don't give us the taxable income amount, but they're going to give us these economic things that happened, and we need to know what adjustment we need to make to taxable income to arrive at earnings and profits this year. So A, the corporation earns tax-exempt interest income of $10,000. We are economically better off because of that income, but was it included in taxable income? It was not. So we are going to add this back to taxable income to arrive at earnings and profits. So it'll increase earnings and profits by $10,000 because it increases economic gain. Part B, we have taxable income including a $10,000 dividend that was reduced by a $7,000 dividends received deduction. So this year, Young Corporation received $10,000 as a dividend, but only had to report $3,000 in their taxable income. So for earnings and profits purposes, we need to increase earnings and profits by $7,000 to reflect the true economic effect of the dividend. Part C, a $5,000 capital loss carryover from the preceding tax year offsets $5,000 of capital gains. So we had capital gains this year. We did not have capital loss this year. We had a capital loss carryover. That capital loss happened in past years. So we need to increase earnings and profits by $5,000. The capital loss will be factored into earnings and profits in the year it happened. So for this one, this is a carry forward. So it was already taken into account in earnings and profits in whatever year that thing happened. And then finally, Part D, the corporation accrued federal income taxes of $25,280. We're going to decrease earnings and profits by $25,280. That amount is not going to be in my income for tax purposes. It's not a deduction for tax purposes, but I am economically worse off because of the dollars I had to pay in tax. All right, now looking at 4-3, describe the effect of a $100,000 cash distribution paid on January 1 to the sole shareholder of a calendar year corporation whose stock basis is $25,000 when the corporation has. So we made a $100,000 distribution. We have one shareholder, and the basis of that shareholder stock is $25,000. So $100,000 of current earnings and profits and $100,000 of accumulated earnings and profits. So again, my distribution was $100,000. And we know Section 316 says a distribution is a dividend to the extent of earnings and profits. And we start by allocating the dividend to current earnings and profits. So in Part A, it's a dividend. The distribution is a $1,000 dividend payable, and it's taken out of current earnings and profits. We start there. All right, B, we have a $50,000 accumulated earnings and profits deficit and a $60,000 current earnings and profits balance. So in Part B, we still start with the current earnings and profits. So in Part B, $60,000 of the $100,000 distribution is going to be a dividend from current earnings and profits. But then we're out of earnings and profits because you see that the accumulated earnings and profits is a deficit. So after that $60,000, $25,000 is going to be a return of the shareholder's basis. So that's not a taxable event. It's going to reduce the shareholder's basis to zero, but it's like we're giving the shareholder back what they invested in the corporation. The rest of the dividend, the $15,000, is going to be a capital gain. Part C, a $60,000 accumulated earnings and profits deficit and a $60,000 current earnings and profits deficit. So we have no earnings and profits. Because of that, we have a $25,000 return of capital. It's going to reduce the shareholder's basis to zero. And then the remaining $75,000 is a capital gain. D, an $80,000 current earnings and profits deficit and a $100,000 accumulated earnings and profits balance. Okay, so here it's all going to be a $100,000. It's all dividend, but it's all from accumulated earnings and profits. All right, and the reason that accumulated earnings and profits is $100,000 is because the distribution happened on January 1. If the distribution had happened in the middle of the year, we would have had to reduce accumulated earnings and profits by a portion of the current deficit. So if it happened exactly in the middle of the year, we would take half of that current earnings and profits deficit, so $40,000, and we would reduce the accumulated earnings and profits balance by $40,000. But since the distribution happened on January 1, none of that current earnings and profits deficit had happened yet. All right, and next says answer parts A through D again, assuming instead that the corporation makes the distribution on October 1. So let's just look at D for that because we basically just talked about it. All right, so if it happened at 10/1, accumulated earnings and profits is $40,000. How did I get that? Well, I said that at October 1, 9 of 12 months have passed. And we know for all of this year, we had an $80,000 current earnings and profits deficit. As of October 1, $60,000 of that deficit has happened. So we subtract $60,000 from $100,000 of accumulated earnings and profits, leaving $40,000. It means $40,000 is a dividend, $25,000 is going to be a return of capital, and the remainder is going to be a capital gain. In this question, Marcia receives a $10,000 cash distribution from Dye Corporation in April of the current year. At the beginning of the year, Dye has a $4,000 accumulated earnings and profits balance and $8,000 current earnings and profits. Dye also distributed $10,000 in cash to Barbara, who purchased all 200 shares of Dye stock from Marcia in June of the current year. What tax issues should be considered with respect to these distributions? So these individuals should consider these. Because the two cash distributions exceed earnings and profits, what portion of each comes out of earnings and profits? We need to know what portion of each shareholder's distribution is a return of capital, what portion of the return of the capital distributions reduces the basis of the shareholder's stock, what portion of each shareholder's return of capital distribution is a capital gain, is the recognized capital gain long-term or short-term? So if you have a client or you are working at a firm and your boss comes to you and has this situation and you see that we have distributions out of a corporation, these are the things you need to consider if you were trying to advise a shareholder or advise your boss how to treat those distributions. These are the questions you need answered. So in this problem, a key issue is to what extent Marcia's distribution is treated as a dividend. So Dye Corporation has $12,000 of current and accumulated earnings and profits, so only $12,000 can be a dividend to Barbara or Marcia. And we know that our rules say current earnings and profits is allocated proportionally based on the amount of dividend to Barbara and Marcia, so $4,000 each. And accumulated earnings and profits is allocated chronologically, so a first in, first out basis. So the remaining $4,000 of E&P is allocated to Marcia. So Marcia has an $8,000 dividend and a $2,000 return of capital. And Barbara has a $4,000 dividend and a $6,000 return of capital. Any amounts received over that are going to be a capital gain. Here we have Beach Corporation, an accrual basis taxpayer. They have the following results of the current year. And we want to know their taxable income and then their current earnings and profits. I like this problem because it's a good review of taxable income. So we know we just need to figure out our gross income, deductions and losses, income before any special deductions and special deductions. So we'll do that first in part A. Before we go over there, we see that gross profit, of course, is part of gross income. Dividends are part of gross income. We have interest. Now, we know that interest on corporate bonds is part of gross income, but municipal bonds are not taxable, so that is not going to be a part of my gross income. We have proceeds from life insurance policy on a key employee. All right, so this generally is not included in my income, so that's not going to be part of my gross income. And then a Section 1231 gain, that is part of my income. And then we have expenses, administrative, bad debt. We have depreciation. It gives us the different means of depreciation, financial accounting, tax income, and the alternative depreciation system. So for calculating my taxable income, we will use the tax depreciation. We have a net operating loss carryover, which we may or may not get to use depending on the limitations based on taxable income. And we have charitable contributions. We made one this year and we have a carryover. Again, we may or may not get to take all of this year's or any of the carryover, depending on what limits apply. We have a capital loss on the sale of stock. We can only take that if we have a capital gain, because remember, we can't take losses unless they offset capital gains for corporate tax purposes. And then we have a penalty for late payment of federal taxes. If you remember back, you don't get to deduct penalties for not paying your taxes on time on your tax return. That would be kind of silly. So let's look at Part A, the taxable income. All right, you can see we have gross profit, dividends, interest. Notice we only have $10,000 of interest because we don't pay tax on the interest on municipal bonds. And then we have a net capital gain. So that is the 1231 gain on the sale of land of $8,000 minus the $1,200 capital loss on the sale of stock to get a net capital gain of $6,800. So our gross income is $286,800. All right, now our deductions and losses. We have administrative expenses, bad debts, and tax depreciation. Notice nowhere in there do we get the deduction for late payment, the penalty for late payment. Okay, and then the charitable contribution. Remember, our charitable contribution limit is 10% of taxable income before special deductions, but after the net operating loss. So our taxable income before special deductions and the charitable deduction is $85,800. We also from there need to subtract out the net operating loss deduction. So it's $85,800 minus $40,000. So we are limited to the lesser of that amount, 10% of that amount, which is $4,580. So you notice we had an $8,000 charitable contribution this year, and we also had a carryover. So that carryover is going to stay. We can't use it. And we're going to have even more carryover because of this limitation. So we can deduct $4,580 of charitable contribution, making my taxable income before special deductions $81,220. All right, now we need to deal with the dividends received deduction. And the dividends received deduction depends on how much I own of that corporation. And remember, the line is 20%. So if I own less than 20%, I get to take a 50% deduction. Between 20 and 80, I get to take a 65% deduction. I own 25%, so I get to take that 65% deduction. Remember, it's the smaller of 65% of the dividend or 65% of my taxable income after charitable contributions. So when I do that math, I end up with a dividends received deduction of $13,000. All right, and then I have my net operating loss of $40,000, my net operating loss carryover, and that is limited to 80% of my taxable income before the special deductions. So I have a taxable income of $28,220. All right, next I want to know my current earnings and profits. And we know we start with the taxable income and we make adjustments. So looking at this list, the things that are going to differ, things that we're trying to get to true economic picture of our activities. So there are some differences, right? When we look through the list, we know we didn't include the interest on municipal bonds. We know we had a limit on that penalty on late payment of federal taxes. That was not included. We did not get to deduct all of our charitable contribution. All right, so, and also the proceeds from life insurance. We didn't include that in our income. All right, so we start with our taxable income and we add back the municipal bond interest. That increases our economic wealth. We add back life insurance proceeds. We add back the excess depreciation. Remember over here, we are allowed to take depreciation for tax purposes at an accelerated rate, but for earnings and profits, we have to use the alternative depreciation system. So we need to add back the difference. We had too much expense, and that's what we're doing here on this excess depreciation. We add back the net operating loss carryover because we dealt with that net operating loss in earnings and profits in the year it actually happened. We also add back the dividends received deduction because the whole dividend benefited me economically. I just didn't have to report it all in my income. We subtract excess charitable contributions because I actually made a full payment of $8,000. So I'm going to subtract what I was not allowed to deduct on my tax return. I'm not going to subtract the carry forward from a previous year because I dealt with that in the year I actually made the contribution. I subtract the penalty, and I subtract taxes I had to pay. We didn't calculate those on the last slide, but income taxes are a flat 21%, so that's pretty easy to figure out. That decreases my economic wealth. So I'm going to go ahead and subtract that. So my current earnings and profits is $227,424. All right, question 32. At the beginning of his current non-leap year, Charles owns all of Pearl Corporation's outstanding stock. His basis in the stock is $80,000. On July 1, he sells all his stock to Donald for $125,000. During the year, Pearl, a calendar year taxpayer, makes two cash distributions, $60,000 on March 1 to Charles and $90,000 on September 1 to Donald. How are these distributions treated in the following independent situations? What are the amount and character of Charles' gain on his sale of stock to Donald? And what is Donald's basis in his Pearl stock at the end of the year? Okay, so A, we have current earnings and profits of $40,000 and accumulated earnings and profits of $30,000. Okay, so remember, it's a dividend to the extent of earnings and profits. We have more dividend than earnings and profits here. And we allocate current earnings and profits pro rata and accumulated earnings and profits chronologically. Okay, so in this chart, you have the person, the date of the distribution, the amount of the distribution, and then how we treat it. So for Charles and Donald, we allocate current earnings and profits pro rata. And what I mean by that is if you see this math up here, the total distribution to both of them was 150. Charles got 60 of that, Donald got 90 of that. So you can see my formula there, 60,000 of 150,000 times 40,000, and 40,000 is the total current earnings and profits. So we allocate based on the amount of distribution. So doing that math, it gives Charles $16,000 and Donald $24,000 of accumulated earnings and profits. All right, so that's $40,000. That's all of our current earnings and profits used up. Our total accumulated earnings and profits is $30,000. That is allocated chronologically. So that all goes to Charles. So Charles' total dividend is $46,000, $16,000 from the current earnings and profits, and $30,000 from the accumulated. And the remaining distribution to him is $14,000, and that is going to reduce his basis. That's a return of basis. For Donald, he is allocated $24,000 of current E&P, but none of accumulated because it's all gone. All right, so his dividend is only $24,000, and he has a $66,000 return of capital. So that is going to reduce his basis. And for Charles, remember he started with a basis of $80,000. That's what he paid for the stock. This transaction reduced his basis by $14,000, so his basis is $66,000. So that reduction in basis is going to increase his gain when he sells the stock. So his gain is going to be $59,000. He received $125,000 from Donald to buy the stock. We subtract his basis of 80, and then we subtract his reduction in basis of 14. So he has a $59,000 capital gain. And Donald has a $24,000 dividend and a $66,000 return of capital, which is going to reduce his stock basis from 125 to 59. All right, now part B, we're going to assume we have current earnings and profits of $100,000 and accumulated earnings and profits deficit of $50,000. All right, so this is how this is going to be laid out. We still allocate current earnings and profits pro rata, just like we did before. So that's exactly how we did it in part A, the same math. Accumulated earnings and profits, we have nothing anyway. So neither party gets any accumulated earnings and profits. So the dividend is $40,000 to Charles and $60,000 to Donald. And then the return of capital is $20,000 to Charles and $30,000 to Donald. All right, just like before, the return of capital is going to reduce their basis in their stock. So for Charles, his Pearl stock was $80. He had a $20,000 reduction of capital, so now it's $60. And for Donald, he paid $125 for the stock, but we had a return of capital of $30,000. So now it is $95,000. And that basis reduction makes Charles' capital gain on the sale $65,000. And then finally, Part C. Now, same thing, except we have a current earnings and profits deficit of 36.5, and we have accumulated earnings and profits of 120. All right, so you can see here, remember, if we have a deficit in current earnings and profits, we have a surplus in accumulated earnings and profits, then we reduce accumulated earnings and profits by the current E&P deficit on each date of distribution. So the first date of distribution is March 1. All right. On March 1, we say 59 out of 365 days of the year have passed. So we have the deficit of 36.5. And so we say as of March 1, our deficit is 5,900. All right, so we reduce accumulated earnings and profits by 5,900. But accumulated earnings and profits, remember, was a big number. It was $120,000. So as of 3/1, Charles' dividend all comes out of accumulated earnings and profits, and it's all a dividend. But for Donald, his distribution isn't till September 1. So there has more time has passed there, right? So on September 1, 243 days of the year has passed. So that current earnings and profits deficit of $36,500 on 12/31, a lot of that has already happened. So we say that $24,300 of earnings and profits deficit has already happened on 9/1. So we started with accumulated earnings and profits of 120. We need to subtract the $24,300 deficit that we allocate to it based on the current loss. We also have to subtract the $60,000 dividend we've already allocated to Charles. That leaves us with an accumulated earnings and profits balance of $35,700 on September 1. So for Donald, he has a $35,700 dividend and a $54,300 return of capital. All right, so his basis is going to be reduced by that. It's going to be $70,700. And Charles' basis is not reduced at all because we treated all of this as a dividend, none of it as a return of capital. All right, so this was for cash. Cash distributions are pretty easy to measure, right? Cash is cash. But what if we distribute other property? Okay, so the amount of the distribution is going to be measured as the property's fair market value on the distribution date. If that property is subject to a liability and the shareholder assumes that, it's going to reduce the distribution amount, but not below zero. The distribution amount is going to be treated as a dividend to the extent of corporate earnings and profits, just like before, so it's not going to change that rule. The shareholder is going to take a fair market value basis in any property received. That basis will not be reduced by liabilities assumed by the shareholder. So, reviewing that again, liabilities are taken into account when measuring the amount of the distribution. It's going to be the fair market value less any liability, but not below zero. However, the shareholder's basis in the asset is not going to be reduced by a liability. And then the holding period for the property is going to begin on the day after the date of distribution. It does not include the corporation's holding period. And gain or loss, gain for tax and earnings and profits purposes. So this is for the corporation. So these are tax consequences for the distributing corporation. The distributing corporation is distributing assets. They have to recognize gain. So gain for tax and earnings and profits purposes, they have to recognize it like we sold it for fair market value on the date of distribution. So I have a note here, gains may not match between earnings and profits and tax income because the basis may not match because of depreciation. No loss is allowed. So if I realize a loss, I cannot recognize it. And if property is subject to a liability, the fair market value is going to be no less than the amount of the liability. And the effect on the earnings and profits. If the earnings and profits adjusted basis of the non-cash asset distributed equals or exceeds its fair market value, earnings and profits is going to be reduced by the basis, the asset's earnings and profits adjusted basis. So if the adjusted basis is equal to or greater than the fair market value, earnings and profits is reduced by that adjusted basis. But if the fair market value is greater than the adjusted basis, earnings and profits is reduced by the fair market value. So whichever's bigger. Earnings and profits reduction is net of any liability to which the asset is subject or that the shareholder assumes. And then earnings and profits is also reduced by the income tax liability incurred on any gain recognized. If a corporation distributes its own debt, earnings and profits is reduced by the principal amount of the debt. So a note, for example, if they distribute out their own note, then earnings and profits will go down by the amount of the note. Here we have Walnut Corporation. They own a building with a $120,000 adjusted basis and a $160,000 fair market value. Earnings and profits is $200,000. Should the corporation sell the building and distribute the sales proceeds to its shareholders, or distribute the building to its shareholders and let them sell it? Why? Well, to answer this question, we need to think about what a distribution means to the corporation. What do they have to do? Well, when they distribute an asset out to the corporation and the asset is not cash, so a non-cash property, they have to pretend like they sold it on the date of distribution. And if they pretend like they sold it, they pretend like they sold it for fair market value. So the answer is it doesn't matter, right? If we pretend like I sell it for fair market value, then I'm going to have to recognize that gain anyway, and I'm going to reduce earnings and profits by the distribution. If I actually sell it, then I have to actually recognize the gain and still reduce earnings and profits by the distribution. So it doesn't matter. Same tax result either way. From a tax perspective, it makes no difference. Either way, the corporation must recognize a $40,000 gain, either on the disposition of the building or the distribution of the building, and the shareholders have a $160,000 dividend. The shareholders' basis in the building is $160,000. In the current year, Sedgwick Corporation had $100,000 of current and accumulated earnings and profits. On March 3rd, they distributed to its shareholder Dyna a parcel of land, a capital asset, having a $56,000 fair market value. The land has a $40,000 adjusted basis to Sedgwick and is subject to an $8,000 mortgage, which Dyna assumes. Assume a 21% corporate tax rate. A, what are the amount and character of the income Dyna recognizes as a result of the distribution? All right, so first, is this distribution a dividend? Well, let's see. We have $100,000 of current and accumulated earnings and profits, and the value of the land is $56,000. So yes, this is a dividend. So what are the amount and character of the income she recognizes as a result of the distribution? All right, so she has a $48,000 dividend because we measure the dividend as the fair market value of the land minus this mortgage that she has assumed. Her basis in the land is going to be $56,000 because we don't reduce the basis based on the debt. All right, part B. Oh, we just answered part B. Part B, what is Dyna's basis in the land? It's $56,000. It's fair market value. All right, C, what are the amount and character of Sedgwick's gain or loss as a result of the distribution? So remember, we pretend like we sold it on the date of distribution for $56,000. And it had an adjusted basis of $40,000, and we had an $8,000 mortgage. All right, so the corporation has a $16,000 capital gain because we treat the amount realized as the $48,000 net fair market value. So the asset's worth $56,000, but it's subject to a liability. So we reduce the fair market value by the liability. So we gave away that, and then we also got a release from the liability. So that's also an amount realized. And then we subtract the adjusted basis of $40,000 to get a $16,000 capital gain on the distribution. All right, and D, what effect does this distribution have on earnings and profits? Okay, so it's going to affect quite a few things. You're going to have a gain. It's going to make it go up. You're going to have tax. That's going to make it go down. And you're also going to have the mortgage. Okay, so net is the $35,360 net reduction. It's increased by the gain, which is the fair market value over the adjusted basis. It's decreased by $48,000, which is the amount of the distribution net of the mortgage. And then it's decreased again by the tax applicable to that gain, so $3,360. All right, problem 36. During the current year, Zeta Corporation distributes the assets listed below to its sole shareholder, Susan. For each asset listed, determine gross income recognized by Susan, her basis in the asset, the amount of gain or loss recognized by Zeta, and the effect of the distribution on Zeta's earnings and profits. Assume Zeta has an E&P balance exceeding the amount distributed and is subject to a 21% tax rate. Unless stated otherwise, adjusted basis for taxable income and E&P purposes are the same. Okay, in Part A, a parcel of land used in Zeta's business that has a $200,000 fair market value and a $125,000 adjusted basis is distributed. Okay, so we know it's going to be a dividend to the extent of earnings and profits. They tell us we have enough earnings and profits. We don't have to worry about that. So we treat it as though we sold it on the date of distribution and distributed it. So for Susan, she is going to have a dividend equal to the fair market value of that asset. So it's land and its fair market value is $200,000. So she's going to have dividend income, taxable dividend income of $200,000, and her basis in the land is $200,000. For Zeta, Zeta has a $75,000 1231 gain. All right, and remember that's fair market value minus the 125 adjusted basis. Zeta's earnings and profits is increased by the gain, reduced by the amount of the distribution, and also reduced by any taxes paid on that gain, so that 21% tax. All right, Part B, same facts as in A, except now the land is subject to a $140,000 mortgage. All right, so that changes things a little bit, right? Now, there's $60,000 of dividend income, and she's going to have a $200,000 basis in the land. All right, Zeta is still going to have that $75,000 gain because remember, they are giving land with a net fair market value of $60,000 and also that mortgage liability. So they have amount realized of $75,000. And it's going to increase their earnings and profits by $75,000. It's going to be reduced by the amount of the distribution, which is $60,000. And then, of course, the tax effect. So the $15,750. Part C, FIFO inventory having a $25,000 fair market value and an $18,000 adjusted basis. All right, so for Part C, she's going to have $25,000 of dividend income and take a basis of $25,000 in the inventory. Zeta's going to recognize $7,000 of ordinary income. All right, so why is it ordinary? Well, it's ordinary because inventory is an ordinary asset. It's not a capital asset. So this is going to be ordinary income, and it's $7,000 because its fair market value is $25,000. And it had an $18,000 adjusted basis. So 25 minus 18 is 7. Zeta's earnings and profits is increased by $7,000 for the income, reduced by the amount of the distribution, so $25,000, and by the tax effect, the 21% of the gain. All right, D. A building used in Zeta's business having an original cost of $225,000, a $450,000 fair market value, and a $150,000 adjusted basis for taxable income purposes. Zeta's claimed $75,000 of depreciation for taxable income purposes under the straight line method, and depreciation for earnings and profits purposes is $60,000. All right, so here we need to figure out the gain, and we know it's a little tricky because depreciation for earnings and profits is different than depreciation for taxable income. All right, so Part D. She has $450,000 of dividend income. Susan has $450,000. That's the fair market value of the building. Zeta recognizes a $300,000 gain for taxable income purposes because we know the fair market value is $450,000. We pretend like we sold it for that. And we know that the taxable basis is $150,000 because they told us we had taken, or it gives us the basis actually. It gives us the basis of $150,000 for taxable income purposes. All right, so we know that we have a $300,000 taxable gain, and we know that because of the requirement to recapture some of that $1245 gain that would have been $1250 gain for an individual, we have to recapture 20% of that. So we had taken $75,000 of depreciation that was given to us, and so that amount of depreciation, we have to recapture 20% of that as ordinary income under Section 291. So $15,000 will be ordinary income, $285,000 will be $1231 gain. For earnings and profits, the basis of the building is $165 because we know that we paid $225 for it and that we have taken $60,000 of depreciation for earnings and profits purposes. So the earnings and profits gain is $285,000. And the earnings and profits is going to be increased by $285 and reduced by the amount of the distribution, the building's fair market value, and then also the tax effect of that. So 21% of the $300,000 gain. All right, Part E. An automobile used in Zeta's business having an original cost of $12,000, an $8,000 fair market value, and a $5,760 adjusted basis. For taxable income purposes, Zeta's claims $6,240 of maker's depreciation on the automobile. For E&P purposes, depreciation is $5,200. All right, so for this one, we have an $8,000 fair market value and a $5,760 fair adjusted basis. We have taxable depreciation under makers of $6,240, but for earnings and profits, depreciation under the alternative depreciation system is $5,200. So she's going to have an $8,000 dividend because that's the fair market value of the automobile. So the measurement of her dividend is $8,000. She's going to have $8,000 of income for that, and her basis in the automobile is $8,000. The corporation has $2,240 of ordinary gain. All right, and we got that by taking the $8,000 that we received minus the adjusted basis. For earnings and profits, the basis of the car was $6,800 because we didn't take as much depreciation. All right, so the earnings and profits gain is $1,200, $8,000 minus $6,800. Zeta's earnings and profits is going to be increased by that $1,200 gain, reduced by the amount of the distribution and the tax effect. And notice the tax effect, I wanted to note this in Part D as well, and I forgot. The tax effect is, of course, based on the taxable gain, whereas the E&P gain is going to be how we adjust earnings and profits for the gain, but the tax effect is measured by the actual tax gain. All right, and finally F, installment obligations having a $35,000 face value and fair market value and a $24,500 adjusted basis. All right, so we haven't really talked about this, but generally this isn't just a piece of property, it's an asset. So she's going to recognize $35,000 of dividend income and take a $35,000 basis in the obligation. Zeta is going to recognize a $10,500 gain. That's just the fair market value minus the basis. And it's going to be a $1231 gain on the distribution from sale of property in a prior year. So the character depends on the character of the property sold. Zeta's earnings and profits is going to be reduced by the $35,000 distribution, the amount of the dividend, and by the tax effect, the $2,205. It is not increased by the earnings and profits gain on the installment obligation because that was already included in earnings and profits when they sold the asset. Moving on to constructive dividends. Constructive dividends are things that the corporation tried to treat as other than a dividend, but the IRS came in and recharacterized them as a dividend. So we know that salaries and wages, for example, that's a deductible expense. It's under deductions and losses. A dividend is not a deductible expense. So we might want to disguise a dividend as salaries and wages to have a better tax effect. And over here on the right are some things that can commonly be recharacterized. So we might recharacterize. So what would happen is the IRS would recharacterize an amount distributed to a shareholder from a deductible distribution to a dividend. It often arises in closely held corporations where shareholders are also managers. So this isn't going to happen in Home Depot, right? This is going to happen when all the shareholders know each other and they also run the business. One of the most common ways to do this involves compensation, like I said. Rather than paying a person $100,000 of compensation and a $400,000 dividend, they just say, I paid you $500,000 of compensation. Then they get to take the deduction of $500,000. It could take the form of a loan. It could also be an insufficient salary if now we might want to make it, for other tax purposes, we want more dividend and less salary. It could go the other way. It could be excessive rental payments for shareholder property. If the corporation leases shareholder property from the shareholder, we might make payments greater than market to get some money out of the corporation and not treat it as a dividend. It might take the form of a corporate payment of a shareholder personal obligation. It might take the form of a bargain purchase of corporate property, or it might take the form of a shareholder using corporate property. Okay, so to review what we did in this section, our whole focus on this section was determining consequences of non-liquidating distributions. And we started with earnings and profits, and that's important because a distribution is only a dividend to the extent of earnings and profits. And it first is treated as coming out of current earnings and profits, and next out of accumulated earnings and profits. And if there are multiple distributions, current earnings and profits are allocated pro rata. Accumulated earnings and profits are allocated chronologically. We first talked about cash distributions. That was pretty easy. We moved on to property. Generally, when a corporation distributes property, they act as though they sold it on the date of distribution for fair market value. The shareholder receiving it receives a dividend equal to the fair market value minus any liability attached to that property, and their basis is the fair market value, including the liability. All right, the corporation recognizes gain like they normally would if they'd sold the assets, so generally amount realized minus adjusted basis, and the effect on earnings and profits includes the gain, the tax effect of the gain, the amount of the distribution, and any other differences based on the earnings and profits adjusted basis relative to the tax adjusted basis.